Welcome to the latest edition of The Bull, the Bear, and You, as we take a look at what is happening in the economy, and also we'll take a look at investing. I'm Stacy Smith, and with me to talk about the economy and investing is my panel of financial advisors and experts, and I'm going to introduce them to you now, and they are Terry Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks again for joining us for another session of The Bull, the Bear, and You. And I trust everyone's been good the last 2 weeks since we've talked. Everybody made a lot of money, right, in the markets?
Well, debatable, but we had a good 2 weeks, Stacy. Thank you for asking.
That's good. Well, since the last time we talked, the major indices have all been posting gains, with the NASDAQ and the S&P 500 setting some new all-time highs. In fact, for the year, the NASDAQ is up nearly 18%, and the S&P 500 is up nearly 14%. So, Kim, you were not with us the last time we met, so I'm going to put the first question to you. Can you give us your take on what's happening with the markets right now?
Sure. Well, I think now that we're pretty much all the way through earnings season, although it's just going to start in a couple more weeks, yay. Anyhow, back on task here. We're not getting necessarily a whole lot of information on companies, but what we seem to be focusing, and this is both retail investors and professionals like the people on this panel, what we're probably focusing on is as the Fed turns, right? What is going to happen to interest rates? And if you've been watching the 10-year yield, which I encourage all of the listeners and watchers to do that, as the yields have been falling on the 10-year, the S&P 500 has been going up. And why is that? Well, there's the math problem about discounting cash flows at lower interest rates makes you accept higher multiples. But I also think that a lot of people are really waiting for the Fed to signal that they're going to cut. And that could give the U.S. specifically more firepower to expand. And maybe the S&P 500 could broaden out from tech and get into, like, I don't know, interest rate sensitive areas like housing. That would be a nice change. And maybe even more consumer discretionary could benefit from lower interest rates. So that's my take. And I think we have a bias going upwards from for the rest of the summer if all things remain more or less equal.
So if I could jump in on that, Stacy, if that's all right, and piggyback off what Kim said. So it's been a very bifurcated market over the past, especially over the past month or so. Kim's right. The S&P, we were in a situation where bad news was kind of good for the stock market. Bad news meaning, okay, unemployment might go up a bit, so the Fed might cut rates, and then the S&P 500 went up. But if you actually look year to date, small cap stocks are negative on the year. So yeah, the S&P is doing fantastic. That's great. But underneath the hood, not everything's doing that great. And now you're starting to see the 10 years come back down over the past couple of weeks. Only the S&P 500 and the NASDAQ have done pretty well. Mid caps are starting to struggle. Small caps certainly have struggled quite a bit. And last year we had the Magnificent Seven. This year it's kind of the Magnificent One. NVIDIA has really, really driven the bulk of the returns in the S&P 500. I think it's contributed about 30% of the overall returns to the S&P 500. So to Kim's point, the breadth is really kind of narrowing, and we need to start to see a broadening out of the market performance, and that's really going to come from the earnings backdrop. I think earnings are going to stagnate here, and what we've seen is I think you're going to end up seeing the leadership kind of continue into the back half of the year is what we saw so far this year in the beginning, meaning it's going to be tech-driven. It's going to be those companies that can continue to grow even though the economy is slowing. So the NVIDIAs of the world, the Googles, et cetera, will likely probably continue their dominance in the back half of the year.
So I'm going to get on my soapbox a little. I am so sick and tired of focusing on what the Fed is going to do. And it's crazy to me. This is crazy how all of this discussion, you turn on CNBC, you turn on any of the channels, and it's all about what's the Fed going to do? What's the Fed saying? The Fed's not supposed to say anything, quite frankly. I mean, in terms of anything that they say, and they do say this when they say it, but anything that they say is data dependent. And they don't know what's going to happen. I thought it was really interesting, Kim, what you said about, not having such, I don't know exactly how you said it, but not having such clarity into corporations, right? Something like that you had mentioned. And it's so true. And that's what we should be focused on. What Michael said about earnings is a big deal because we're starting to see unemployment go up. Not a concern yet, but guess what? We're on our way to get there. So we are seeing layoffs. When you look at the impact of interest rates having gone up on corporations that are now refinancing their debts, we're starting to see that have an impact on earnings. And you look at the value of the dollar, right? Like the rest of the world is lowering interest rates. We haven't. That makes our goods more expensive overseas. So for these multinational companies, that's going to be a drag on earnings. Now, they do try to hedge that with various strategies, but at the same time, it can have impact. So I think as we're heading into next earnings season, earnings are going to be what drives the market, in my opinion, not necessarily what the Fed is saying, because no one's, the market really isn't kind of paying attention to what the Fed is saying. And when we see rates come down, it's for a reason, because the economy is slowing. So we really do have to pay attention to corporate earnings.
That being said, this market looks a little sanguine, I guess is the word, but it's kind of like a duck on a pond. If you've ever looked at a duck on a pond and they've shown you the activity under the surface of the water, that duck is paddling fervently to get wherever it's going, but up above the ground, above the water, looks like it's just sitting there. And this is the way this market looks. NVIDIA is driving the indexes, but underneath, when I drill down and see some stuff, I see that the overall corporate sales in the United States have been flat since 2022. There's been no growth in sales. And if you throw NVIDIA's astronomical growth in this period of time, that tells me the rest of the market's sales are actually a little weak. So I think this economy, I shouldn't say the economy, I think the corporations are struggling more than it appears. Sooner or later, that's going to become apparent. And then I'm not worried about a bear market unless we have a bank collapse. But I do believe we'll have some sort of a correction out here, just because other than, Mike, you said it I read a headline today, the Magnificent One instead of the Magnificent Seven, whatever the number is, those few, other than those stocks, the rest of the market's working hard.
All right. Well, let me throw this out, because I get the feeling that the three of you are maybe in a little bit of a disagreement then with Kim, in that Kim said she felt that the market was going to continue to go up through the summer. Do you guys disagree with her on that then?
Personally, that's a 2-month forecast. She could very well be right. It's been going up for the last 3 years to me, inexplicably.
I mean, I have friendly disagreements now and then, so I don't know. The summer's always choppy to begin with.
Right.
So now, we're dealing with long-term investors. So as I look at a choppy market over the summer, people hate it when we say this, but it gives us buying opportunities. And I can tell you, and this is where Kim and I really do share some passion, the impact of technology and the impact specifically of AI, it's going to change. It's going to change how things are done in a positive way.
I agree wholeheartedly with that. And that's probably the thing that I get asked for my opinion a lot on other networks and other shows. But my biggest message that I've been desperately trying to tell investors is, just because you don't have NVIDIA doesn't mean you're missing the AI opportunity. It's going to take a solid 10 years to really play out. This is like the internet in 1996. And just because you didn't own Netscape, the world has not come to an end. And it takes time for this to play out. And I'll tell you, I don't even know that we've seen what the killer app is on AI. Like, for me, the killer app for the internet was email. That really did allow us to have conversations with each other and at asymmetrically, or where I could email somebody at, I don't know, 10 o'clock at night, and you can email me back at 10 o'clock in the morning, and we could have this, kind of good professional discussion with, you know, productivity enhancements. We'll put it that way, instead of having a meeting, right? So we don't know what AI is really going to do, but we know it has potential for productivity. So hang on there. Don't get desperate and just start piling into, stuff that's worked so far.
Okay, great. We need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. There was an interesting headline in the Wall Street Journal over the weekend. It read, "Investors fear long stretch of calm in markets can't last." The article states that investors are calm because the economy remains stronger than almost anyone predicted, that corporate profits are rising again, according to this article. Inflation seems to be cooling, and the Fed indicated there might be, yes, a rate cut this year. And then came the caution part. Part of the problem with a strong economy is an environment where people let their guard down and then turn to riskier and more speculative investments. So I know that none of you would ever recommend a risky investment. But Frank, how can you determine if an investment is risky or not?
Well, let's first define risky. Risky to me is making an investment that is black and white. You either win or you lose all your money. And you're right. None of us make those recommendations. And the reason is that is a risk that I don't think anyone should take. If you want to do that, go buy a lottery ticket. You know what's going to happen. You're probably going to lose your $2, but it's only $2 and it ends quickly. In the case of investments, it could take 2 years for you to lose your money. But the odds are you're going to lose your money. So let's talk about risk rather than risky, because risk means it goes up and down. And then with risk, you need to measure your time horizon. Because if you have a 10, 20, 30-year time horizon, then you can afford volatility and use those downdrafts to add to positions or add to other markets that you're a little light in, or make adjustments according to what you need to accomplish. And that's great. If you're like me, old, you can't afford maybe to live in a downdraft, and you need to avoid risk a little more. And that's just something that you need to measure. And if you're like Warren Buffett, you can ride any roller coaster you want because it really doesn't matter what happens. So that's how I look at risk, not risky. Risky, you're right. I don't even want to talk about it. I'm not interested in losing all my money.
Frank, can you show everybody your GameStop poster you have behind your desk? Frank's right, though. I mean, I think too many people look at buying a stock as opposed to buying a business, which is really what you're doing when you're buying a stock. You're buying that business. So think about it. If you're going out there and just you had the opportunity to buy one business, you probably wouldn't buy one and pay 30 times or 40 times the earnings that generates, because that would take 30 or 40 years for you to get your money back, right? So when you look at buying a stock or buying a business, I think right now quality is really what you want. Somebody with strong free cash flow, a company that is generating good earnings and good revenue growth there, as opposed to something that's incredibly speculative and hoping, fingers crossed, as Frank said, that you might make a quick buck, because that's gambling. That's not really investing.
I agree. I concur with everything everybody said, but I do, Frank, you brought back my very first boss in this business, which was Dr. Larry Horan, who had Parker Hunter, who had a PhD in econometrics. And one of his battles that he fought was that volatility did not equal risk. But because we were a brokerage firm and we made our money with people trading, we had to highlight volatility, and that became risk. But if you're going to be a buy and hold, buy a good company, own a company, the price movements are almost meaningless. It tells you things about what investors think about the stock, but not necessarily the worth of the stock, because you're going to hold it for a long time and let it work out. And I just wanted to throw that in, that you brought back Dr. Larry Horan to my mind, that risk is not volatility.
Yeah, that is such an important point, and we communicate that to clients all the time, that, you know, it's very different, volatility and the risk of losing your capital permanently. So in our industry, there are ways that we do this. I mean, when we're working with clients, we assess their risk with different questionnaires and so forth to really understand what their risk tolerance is, because someone says to me, I'm conservative, my definition may be different than the client. So it's very important for people to understand what their risk tolerance is. And then when we're putting together portfolios, we are able to measure and really match volatility to what their risk tolerance is. So, there's a method behind the madness on how you actually group different types of investments together in order to create a portfolio that has the desired upside potential with the appropriate level of risk. So, that's an important element, because the biggest mistake that people make is to sell when things are low. If you really don't understand what your portfolio looks like, and that volatility comes and goes, you run the risk of jumping ship at the wrong time.
Well, I have to ask this question, and maybe we can wrap it up pretty quickly here. If that is the case, then and Michael, you brought up that the one stock, GameStop. Why do people do that? Is it they're just gamblers at heart, or what's your analysis of this?
Well, I
Anybody?
can tell you,
Mike?
I've actually had conversations with people that are riding the GameStop wagon, and it's like going to the casino. They know it. I mean,
Okay.
I don't know anyone. I've not talked to anyone that's like, yes, GameStop, great company, it's going up. They're really putting their money in the hands of, what's his name? What's
Right.
his nickname?
Roaring
Something
Kitty.
Roaring
Kitty. That's it. Yeah.
And it's all about the investment in Roaring Kitty to be able to manipulate the stock price, in my opinion.
Okay.
In my opinion, he's manipulating the stock price.
All that being said, Stacy, is this happens because people have a painfully weak education in financial matters. They don't understand what they're doing or why they're doing what they're doing. And it's our job. And I've read in an article this weekend, I think it was in one of the local papers, where Bob, Michael's guy, and Carrie's associate are working, along with Gene Natali, are working closely with the Pittsburgh School District, trying to develop a program. And this is fabulous work. And tell everybody I'd love to get involved. All right, and I have more time than any of them, except maybe Bob.
All right, that's a good point.
That being said, this education is critical. I started getting my education at 12 years old. I was lucky. All right. That is not common. And it's a matter of education where people learn to evaluate what they need to do, what the tool of money is, and how you use it to take you where you want to go, and develop a knowledge of where you want to go. This is all critical. And if you're doing that, you're following more or less what we all believe needs to be done with money, as opposed to this gambling stuff that people love because it's fun.
Yep. Okay, we need to take a break. We'll be back in just a moment. Welcome back. Michael, it's not uncommon for a company to offer a stock split and for other companies to buy back their stock. So my question is, why do they do it? And what should an investor do when either one of these things happen, a stock split or a buyback?
Well, I'll start with buybacks. Buybacks are a great tool for investors, right? There are essentially two ways for a company to give back value to a shareholder. That's either through a buyback or through a dividend. Dividends are taxed as ordinary income. Buybacks, Kim would probably know better than me. I don't think really taxed much in that way, but it's a way to increase your value in a company because you get more of the pie there. So, big fan of buybacks. As companies buy back their stocks, that's a signal that management likes the prospects going further too. A stock split is it doesn't create any value to an investor. You can have an 18-inch pizza pie if it's cut 2 ways, or if it's cut 18 different ways, it's still an 18-inch pizza pie. However, there's a psychological aspect to it, and investors, as Frank mentioned, might not have the financial acumen to really understand that. Sometimes they just see the price and they think it's cheap, and they might buy into it a little bit there. The reason a company splits their stock, historically, if it was over like $1,000, many investors can't buy $1,000 stock. Now that there's fractional trading, that's less of an issue going forward. But the other small reasons are, one is the options market likes a smaller price stock. Secondly, even though it's the worst index in the entire world, the Dow Jones is a price-based index. So a company like NVIDIA at over $1,000 likely wouldn't get into the Dow Jones index unless it went through a stock split. So I wouldn't be surprised if NVIDIA crept its way into the Dow Jones by the end of the year. Because of
it is a psychological thing to have a smaller priced stock, and a lot of investor relations professionals will tell you they do this, and not really a headline name like NVIDIA, but I don't know, like kind of DuPont, or not like a household name sort of stock will do a stock split, because they want to encourage retail investors. And generally speaking, although GameStop aside, retail investors tend to be buy and hold sort of people. So that largely is what a stock split does, is it allows retail investors to feel more comfortable. Like, let's take a $400 stock that becomes an $80 stock. They might look at it and look at the business, not necessarily the valuation metrics maybe, but it looks better to a retail client. So that could be one of the many reasons why a company splits its stock, to encourage longer term holders rather than hot institutional money.
So, Stacy, I know that you're the question asker here, but can I
Right.
ask a question?
Yes, absolutely.
So I'm curious specifically with Michael and Kim, stock buybacks, they've always kind of perplexed me, because when a company buys their stock back and they reduce their shares, their earnings go up. Like, do you ever look at that as a negative?
Yes.
I think Kim would look at it as a negative because they're not reinvesting in their business. I look at that as sometimes there's opportunities to reinvest in the business and expand your opportunity set there. Other times it's great to give cash back to investors that way as opposed to a dividend.
I just thought, like, the way that where it has me not concerned, obviously, both it makes sense to do. I think if people were analyzing stocks and just looking at earnings growth without really understanding where that earnings growth is coming from, they could get in trouble.
Yes.
This is potentially a problem in the entire market, because the entire market is shrinking due to that and other reasons. People going private because of the private equity market's growing so much. There's all sorts of moving parts of these things. Nothing's ever very simple.
Yeah.
Now, this decline in shares, if you will, to me, long term is a problem. For the week, it doesn't matter much, but for the long term, I'm not real comfortable with all this buyback stuff or this acquisition by private equity. And I don't want to make this political, but I wonder if what the government is doing to make it hard to do this has a throwback to the Roosevelt eras, where they put the Sherman Antitrust Act in because they're worried about today's version of the robber barons, if you will. All right. Flip side of that is Elon Musk has done wonders with his SpaceX and the whatever he calls that set of satellites out there that does communications. No government was able to do that. He was able to do it. So I look at that. There's two. These are double-edged swords, and I look at them both. I have no idea what's right. All right, but it's certainly stuff to talk about, and the buybacks are part of this. And
Well, let
I
me
worry about the capital market shrinking to the point where they become less valuable. And that's very important to the United States in my mind, that we continue to have the robust capital markets that we've had for the last 100, 150 years. I think that's really important. And I think we're losing sight of that a little.
let me, like, if you don't mind, I'd like to go back to something basic here about the buyback and the stock split. Am I correct in saying that a corporation decides it's going to have, let's say, 100 shares of its stock available, and it puts it out in the New York Stock Exchange or wherever it might be, and then people buy that stock? In a buyback situation, then the corporation is going back and buying its own shares of stock. I mean, it is actually paying money for its own shares of stock, right? And
Right.
then does that then forever reduce until they make another decision the number of shares available? I mean, can the company sit on these shares and then put them back out again at some point?
Yes.
Kind of, because this could be like a whole class, a whole 7-week class on the how stock works in a company, right? At a graduate level. So we don't talk about treasury shares, and we certainly don't talk about stock awards, because that is dilutive, and they're not yet, like if you work at the company and you've gotten a stock grant or a stock option, you have an option to buy. So a company has a pool of stock that it can create, kind of like a stock checkbook. And so whenever it buys it, I think it goes into treasury, the little treasury department, so that it didn't go and actually die. But in their corporate documents, they have a cap on how many shares they can have outstanding at any one time. But the buyback does, because it's going into treasury stock, how much ever money they've spent and shares that they've recovered, that then on their balance sheet, boy, is this exciting stuff. It goes into the treasury area, and you have a smidgen more, okay, of that company. If you look at a company like Apple, they've been super aggressive at buying back their shares during a time at which the company wasn't growing. But it was confusing because the number of shares, that's how you get the earnings per share, right? So you divide by the number of shares outstanding, which, by the way, if we're going to get really nerdy here, that includes the diluted, the potential shares that it's issued to its executives, board of directors, and employees. So it's kind of a mythical number anyhow. So, but Apple has looked like it's growing when it really hasn't, because of that share count, right? The other thing I have to say is, and Michael brought this up, we're at completely opposite ends of this spectrum. Michael likes the buyback. I'm asked on a lot of surveys from companies and from people who survey people like me, what do I want to see from a company? And the first thing I want to see is that it invests in its own good ideas, or it buys other companies, or it retires debt. Like buyback is way down there. It's almost buybacks and dividends. I don't care. I want you to grow your company. I don't want to get money back that way. I want you to make your pie bigger.
So,
And Kim just said, excuse me, Carrie, Kim just said something that's critical. Buy other companies. When you buy back your stock, you now have stock, which is a currency that can be used to buy other companies. So it's not all bad. I mean, these things all cut many ways, not just two, many ways. So you can't look at it as just one thing and it's all bad or all good. Sorry, Carrie.
yeah, no, I was going to say this is really good because it goes all the way back to the first question about risk. And, Kim's approach to the markets is exactly what she just said. She doesn't care about dividends. That doesn't mean that there aren't people out there that care about dividends, because if you're looking for some sort of income generation, you have to look at the market in different lenses. There are growth companies and there are value companies. And value companies generally aren't going to have obviously the high growth that a growth company has. So this is really goes back to where's your risk tolerance and how should a portfolio be crafted.
Wow. We are out of time, and we didn't even get to the last question, so I'm going to bring that one up the next time we meet, and that has to do with IRAs. And if you guys wouldn't mind, I'd like to continue this discussion on the buyback and the stock split, because people have stock, and this happens to them. And I think you're right in saying that when the stock split happens, most people go, "Oh, wow, that's neat. I got 10,000 more shares of stock," or whatever it might be. But they haven't really gained anything because the price has just been reduced to accommodate the number of shares that you have. All right, that's what I have to say, and I'm not even a financial guy. But anyway, I would like to continue this sometime, and I want to say thank you to Carrie and to Michael and to Kim and to Frank for being with us once again for The Bull, the Bear, and You, and I hope that you join us again for our next edition in about 2 weeks. Thanks for joining us. Bye-bye.